All right. Good afternoon, or morning, actually. Still, I guess it's still morning. So I will give it a little bit of time for anybody that is planned on attending this, to join in um, before we get started. So that'll give me a minute to pull up my notes and get ready for our discussion. So I know we've got a few people that had registered for this, so hopefully they will they will be joining us shortly. And if not, I will get started in a few minutes, and everybody can watch it at their leisure. Okay. Well, it's 11:01, right a little bit after the top of the hour. So I will go ahead and get started with our monthly market update for June 2026. So welcome and thank you for joining me or watching this video once it's posted. This webinar continues the monthly sessions to discuss what's happening in the global and domestic markets um, and the economy, and to provide you an opportunity to ask questions and discuss what you and I are hearing and seeing out there in the world as it relates to money and finance. In the email invitation, you should have received the market update quick hit summary. Then that summarizes the key points for the month. You are welcome to watch the video blog posted by Chris Fasciano, who is Commonwealth's Chief Market Strategist. And I will be providing some more video opportunities for you in the coming months as we approach our transition with LPL. In addition to these webinars I conduct, Chris's videos also provide a quick summary of the important factors that are impacting the markets and the economy and your finances. So utilize both myself as well as Chris as a resource if you have questions or need guidance regarding your investments or markets. I'd also like to highlight that much of this information can be found on our website at www.leslieroperday.com. So you just click under the markets tab and you'll find both the videos as well as the reports that we send out for you to look back on. I'd also like, before I get started, to apologize for missing last month's webinar. I did have the opportunity, or I'm sorry, not the opportunity. I had a personal situation that prevented me from hosting the webinar. So hopefully we can get caught up from where we left off back in April. So with that, let's get started. I'll summarize the monthly market update for you and discuss some of the factors that I think are worth mentioning, and then I will open it up for any questions for anybody that actually is joining us. All right, first and foremost, so here is the market quick hits. So I'll just kind of read through this. So markets wrapped up May on a strong note, extending the rally that began after the March sell-off. While ongoing geopolitical risks continue to exist, hopes for a negotiated end to the Middle East conflict and strong corporate earnings buoyed investor sentiment. And I think that does summarize a lot of what happened in the month of May. So beyond the headlines, there was very strong earnings growth over the last quarter, and that is what led the way in the month of May for the market growth. Fixed income, we had a volatile month with rates kind of spiking in the middle of the month, but then pulling back. We obviously have some geopolitical and economic risks with the ongoing situation in the Middle East. And then looking ahead, while risks continue to exist, the fundamentals should continue to support market growth into the coming months. Okay, so that is the quick hits. Let's look at some of the details and what the markets have done. Okay, so as I mentioned, the month of May was a particularly strong month in the markets. All of the major indices ended positively. So the S&P 500 for the month of May was up 4.8%. So almost a 5% rise just in 1 month. That's pretty significant. The Dow Jones was up about 3%, 3.1%, and the tech-heavy NASDAQ was actually up 7.4%. International stocks also gained ground. So the MSCI is the kind of index indicating developed international markets. That was at 4.87%, also at almost 5%. And even the bond indexes, it had a rough middle of the month with the spike in energy prices and some concerns about how long the Iran situation is going to drag on. But it rallied towards the end of the month as energy prices fell for the month. So pretty much all the way around, it was a good month, a month of May. If we zoom out a little bit and we look at how the markets have performed so far year to date, I think by most measures we can say that it's been a pretty phenomenal first half of the year so far. The S&P 500 is up almost 11%, or at least as of through the end of May, is up 10.73% for the month of through the month of May. The Dow Jones is up 6%, and the tech-heavy NASDAQ is up almost 16% for the year. Those are actually, typically full-year types of returns. So, but obviously, the year is not over. We're only about halfway through it, so a lot left to go. The MSCI, so the International Stock Index, is up 14.6%. So, and the bond index still relatively flat versus the beginning of the year, but up about 0.38% for the year to date. Now, I'd like to also just, kind of look at where we've been over the last year, and kind of put this into context. So, if we look at how things have performed over the last 12 months, just the last month, the last year, it's strikingly, it's just these are pretty amazing numbers. That the S&P is up almost 28%, or actually over 28%. The Dow is up over 20%, and the NASDAQ is up a whopping 41% over the last 12 months. The International Stock Index is up 33% for the last 12 months. And even the bond index is up 5%. And that's actually probably tapered down a little bit because of the rising interest rates. But it's still a pretty significant return just in 12 months for these indices. Now, if we look at the 5-year numbers, I mean, it paints a pretty stark contrast of where we've come from. So in the past 5 years, the S&P is up almost 80%. Okay, the Dow is up 47, almost 48%, and the NASDAQ is up a whopping 96%. So if you were a stock investor of any sort for the last 5 years, you've done well, historically speaking. International stocks are also up about 54%. So over the last 5 years, they did struggle for a while, but international is definitely catching up. And the bond index, that definitely dragged for the first part of this 5-year period. So it's only up about 1% over the last 5 years. A lot of that being driven by the decline in interest rates, which is kind of we've now sort of flattened out from that point. So that's the market indexes for the last last month all the way through a 5-year period. So just really something, striking to point out. Now let me just kind of talk about what's going on in the markets and, maybe what's some of the factors that are driving both the short term as well as the longer term growth. All right. As I said, May was definitely a good month with what I had just said about the different indices. Much of the growth that we've been seeing has been attributed to what I really classify as kind of eye-popping corporate earnings that have been reported for quarter 1 of this past year, and we've had strong growth for the last number of quarters. So we have now had about 96% of companies having reported earnings for the first quarter, and the S&P 500 posted an average earnings growth rate for the companies of 28.6%. That is the highest reported earnings rate in almost 5 years. And it's twice what analysts were expecting, right? So we haven't really seen that type of growth rate in earnings since coming out of COVID. And mind you, that was when we had all these companies that were shut down and couldn't make money. So analysts, that's twice what analysts were expecting the earnings rates to be. Full year earnings estimates have been revised up about 7% so far, and that may actually even continue to rise. So we will see how that continues to play out. But that is by and large the biggest driver of why we have seen the market grow so significantly, particularly in the last 12 months. So much of this earnings growth has been driven by tech, specifically the Magnificent Seven, i.e. the hyperscalers related to the artificial intelligence tech boom. And while the level of investment in data centers and AI has been enormous, these companies are also making huge amounts of money, and that is supporting the expectations of continued growth. So many of us who lived through the dot-com bubble have seen similarities between the hype back then and what's going on now, and have expressed some concerns about, are we in a bubble, or are things overvalued? And that's certainly something to be concerned with. However, one of the key significant differences between what happened back then in that dot-com bubble and what is happening now with the companies that are operating in this AI space, the differences are real, and that these companies are making real money, and they're making lots of it. So back in the 90s and early 2000s, we had companies that had high valuations, but little to no actual revenue. They were huge on paper, but they didn't have any actual intrinsic value other than what traders were willing to pay for them. And this is different because these companies that are hyperscaling AI are real companies with real products, real sales, and they are continuing to grow significantly. Yes, they're making large investments. We will see if those investments ultimately pay off, but they are not, paper companies, shall we say. So I don't want to say this time is different. There are some significant differences between now and then that appear to be driving these phenomenal returns. So it could be different, but we also, could we be in a bubble? Maybe. Anyway, okay. So these returns also do seem to fly in the face of what's happening economically and globally. Specifically with the conflict in Iran. Much of that situation in the Middle East has impacted global energy supplies and prices. And I think under normal circumstances, that would have caused significant market pullbacks and potentially even a recession. And that is something to watch, but it doesn't seem to be having the effect that most people would expect regarding the overall global economy, at least not yet. Now, it's something to watch. Like I said, last month, the consumer price index was up 3.8%, and the producer price index, which is the one that economists tend to watch more closely, was up 6%. And that is the highest level of inflation that we've seen in the last 2 to 3 years since coming out of COVID with all economic stimulus that was being thrown around. So a lot of that increase in inflation obviously is being driven by higher energy prices related to the constricted supplies of oil in the global markets. Some of the market rally in May was driven by a pullback in oil prices because there was some expectations about a potential resolution on the conflict. Oil fell from its high of $124 per barrel down to kind of the mid 90s. I don't personally expect this situation to resolve soon or easily. So I'm just cautioning people to be prepared for some higher levels of inflation for a while until this supply and demand situation comes back into balance, whether that's through resolving the Strait of Hormuz, Middle East oil supply, or the building out of additional supply and oil pipelines, et cetera. So that's probably going to take some time to resolve if we don't get some sort of a political resolution to the situation. Those higher energy prices, at least not yet, have not seemed to make a significant dent in the US economy or the jobs market. The April employment report came in at 115,000 new jobs created, which is a very healthy number of new jobs created for an economy that many people believe is on the rocks. The previous month's employment reports were also revised up as well. So this is just showing that the overall economy and the jobs market continues to be fairly strong. And that's coming on concerns that, the AI revolution was going to take a lot of people's jobs. Could that still, happen? Yes. But right now it seems that we're still making a healthy amount of jobs in this country. And that's a good thing for our economy. Another surprising element is that the higher prices that we have seen have not yet seemed to significantly impact consumer spending. Consumer spending was up 0.5% in April, which is a pretty healthy increase for a month. And granted, a lot of it probably is related to higher gas prices, but it also shows that consumers have not yet significantly cut back. So maybe they're just on hold for now. I'm not really sure, but it does suggest that consumers in this country and globally are kind of continuing to adapt to the situation that we're in on the energy side. So that's good news, because the offset is that even though consumers are still spending, they still feel terrible about their finances for some reason. We are at a consumer sentiment index level posted in May of 44.8, and that is near historic lows. So it's a very interesting dynamic that going on right now that, at least according to the collected survey metrics, consumers are feeling terrible about things, yet they are continuing to spend. And, largely driven by the fact that U.S. household net worth, the average U.S. household net worth has actually never been higher. Very interesting dynamic right now. So I think on the street, when you talk to people about inflation and consumer prices, it's just, things are terrible. They've never been more expensive, but they're continuing to spend, and their net worth, the average American net worth seems to be doing well. Now, some of this disconnect could possibly be attributed to the description about the K-shaped economy effect, which is described as those on the top doing better than those, and those on the bottom. So those on the top doing better and those on the bottom doing worse. I'm not really sure. That's really something for academics to answer. I'm just here to report the facts and point out my observation that it's quite an interesting dynamic that we're seeing right now. Okay. The economy seems to be continuing its slow economic growth. We've seen some market volatility, and will likely continue to see some market volatility due to energy and consumer uncertainty. But we are seeing strong and continuing to expect strong corporate earnings. So while we could very well see a pullback, and to a certain extent, I guess maybe we're seeing that right now happening in June, the fundamentals also point to continued market appreciation. So, okay, it does not look like we have anybody that's attending today's session other than our staff. So there's no questions, at least not that I can see. So I'm going to just bypass any questions, the question and answer period, and talk about what's coming up. The next monthly market update will be on Wednesday, July 8th at 11 a.m. So please keep your eyes out for that invitation. If you have friends or family that you think would enjoy participating, you're welcome to forward the invitation. Our next webinar on financial planning topic will actually be a video on Roth accounts. I was previously planning to connect that webinar last month, but because of the health situation with my wife, I was not able to conduct that webinar. And she is doing better now, but I won't have a chance to conduct the live webinar this month. So I'm going to send it out by video. I will pick up the next live webinar in July, on July 22nd at 12 p.m. And the topic will be, So You Want to Be a Landlord, Financial Planning Strategies for Real Estate Investors. So I hope you may consider joining me for that session as well. As always, you're welcome to find any of my previous videos on various financial planning topics on our website under the events section. Just click on past events, and by clicking the watch the recorded video link, you can watch my previous videos. And as always, if there's a topic that is of interest to you, please shoot me an email or give me a call, and we'll see if we can get one scheduled for you. So, okay, that's all I have for now. I wish everyone a wonderful June, and we will see you again in a month. All right. Okay. Thanks a lot, everybody. Take care.